the 13th. We're getting close to Santa Claus. The oil markets are still experiencing a lot of volatility. We saw only yesterday a $2 move up on again the return of the supply concerns, which we had seen sort of be trumped at the end of last week, early this week, by demand deficit, demand destruction outlook. But no, supply tightness has come roaring back to remind us of the year that we're in between these two seesaws. Let's welcome Matt Stanley, Partnerships Lead Middle East for Kepler. Matt, as we go into the end of the year, which of these two do you think is going to win out the narrative? It seems that the market's taken the oil price cap in its stride and anything else that's been thrown at it.
Morning, Sean, and season's greetings. I hope you're a good boy this year.
Well, I was, yes. I didn't celebrate when England lost in the World Cup, so I hope that Santa will be very good to me for that. You know, that was a very benevolent thing.
I've just seen a football land in my garden, so I think that's Kane's penalty, actually. Anyway, moving on. No, look, it's again, I think the rhetoric has been all year is worry about supply. Demand, I think, was nigh on inevitable that was going to come back from China. I didn't expect to sort of give up on their zero COVID policy as quickly as they did, but that will give a surge to the bulls. The issue with this week is all about the Keystone Pipeline. You know, we've got to look at US. The oil industry has changed somewhat dramatically this week, not in terms of the amount they're producing, which is about 500,000 barrels higher on the year since the start of the year, but it's the exports. Exports are at record highs, just under 1 million barrels a day. Last week, the EIA report was out, and for the first time since I think September last year, 2021, the Houston Ship Channel closed for 3 or 4 days. So that meant there was zero exports out. The market looked at that and is just seeing what's going to happen come Q1. Look, the price cap, I think, has been largely ignored. I can't see how that's enforced. I think it's a political statement more than anything to do with the fundamentals. It's what happens in Q1, 5th of February 2023, when the EU banned Russian oil products, and what happens with gas oil predominantly. That's what the market is really looking at. And that will be the driver for the first couple of months, because right now, the rest of the world can't really replace that flow. So Q1 is really going to be the driver. But up until the year end, flat price is getting the boost from supply issues.
Malia Bengali, founder of MB Commodity Corner. Malia, with all of this volatility still rattling the markets, it seems like your investment funds, all that money that poured into the oil markets early in the year, is slowly but surely draining away from this market. Your thoughts as we go into the end of the year?
Morning, Sean. Yes, at the beginning of this year, the market was convinced of a commodity super cycle, and we had houses like Goldman calling about massive backwardation and positive roll yields. But everybody was forecasting a demand in synonymous with post-COVID demand surge. And we know demand's never a constant. Nobody actually realized what demand could be as the world moved to a recession. And we're seeing that filter out right now. As we see a mismatch between demand actually falling more than supply, prices have receded. And we've been saying this for the last 5 or 6 months, that eventually demand's going to catch up with the tight supply. Now, having said that, we are entering a seasonal market right now where we have winter heating demand picking up and you have some supply issues. So winter can get a bit tricky, but oil prices have fallen $60 from its highs when everyone has been very, very bullish. And also macro, let's not forget, we have a lot of issues. Today, we have the CPI release, we have the dollar Fed liquidity issues. How much are they going to raise interest rates? Are they tightening into a recession? All of these factors are playing very much into commodities. But one thing's for sure, the demand has fallen a lot and all these curves have moved into a contango. So that bullish super cycle narrative has pretty much been misplaced, because commodities are all about timing. It's not about today, it's about what they will be tomorrow. And I think that's what's playing out.
Daniel Richards, MENA economist at Emirates MBD. We're going into this coming days now, Daniel, the final Fed meeting of the year. Of course, this year has been defined by the aggressive Fed tightening cycle, which now seems to be stepping back from that. And as a result, we're seeing a lot of optimism back in the financial markets. What are your expectations going into the meeting this week, and how it's likely to play out for the macro picture?
Yeah, so a nice busy week just before breaking up for Christmas. Big events, of course, we got the CPI today, FOMC, and many other big central banks towards the tail end of the week. So obviously the key one of that is the FOMC. We've had that run of 75 basis point hike, pretty extraordinarily fast monetary tightening in terms of what we've seen over recent decades. We would expect it to slow. We're agreed with the market. We've been saying for some time that it will be a 50 basis point hike. They will come off the boil a little bit. But, it's a funny 2022 when we're saying that a 50 basis point hike isn't very high, right? That's still a pretty strong move higher compared to what we're used to. It's going to take into the upper bound up to 4.5%. It's a long time since we were there. So, it's all about, that's pretty much boiled in. We had that high PPI inflation print on Friday. Maybe if there's a massive upside surprise on the CPI later, there might be some dissension. But I think the chances of it not being 50 basis point are pretty slim. What we're going to be looking out for, of course, is the renewed predictions. Where do they see the terminal rate? Is it going to be 5%? Could it be higher than 5%? And how long is it going to stay there? How long will they keep this restrictive policy in play? I mean, the likelihood is the economy is coming off the boil. The second half of 2023 should be somewhat weaker, and presumably they start to maybe ease off in the second half of the year. But yeah, that's the key thing I think to look out for today, those predictions.
Is there a sense, Daniel, that the Fed's strategy has worked? I mean, we're seeing some easing on inflation data in recent weeks. Can the Fed feel going into the end of the year that this is the right move to ease back, that their mission is accomplished, so to speak? The shock and all 75 basis points.
It's a tough one to call, right? Because a lot of the inflationary drivers have been those exogenous factors, which they didn't really have the control over. And when you look at the services and shelter and such, like, they've been picking up through the period that they've been hiking. So if inflation is now coming off the boil, is that really down to the Fed? All right, it might have been stronger than it would have been otherwise, but I don't think we've seen a massive slowdown in terms of what they would be directly affected. The housing sector, I guess, is the one where we really have seen those interest rate hikes manifesting in terms of a slowdown there. But you look at the labor market data, most of the other kind of key macro indicators, they haven't as yet shown a significant slowdown. But as Jerome Powell's been saying, there is a cumulative lagged effect. This could come into play pretty quickly in the coming months. As pandemic era savings have now been pretty much eradicated. So I think the coming months will be when we tell.
Matt, now that you've had a few months to settle into Kepler and become an expert in all things shipping, what is the magic box of Kepler telling us about the impact on shipping from the price cap and all of the sanctions? We've definitely noted in recent months oil tankers making much longer journeys. The day rate for tankers has gone up to over $100,000. We have a story overnight. There was some sense, the Russians can fill the gap with their own. But the Russian ship insurer says it won't fill the void caused by sanctions. Matt Stanley, what is the shipping crystal ball of Kepler telling us as we come into the end of the year with all of these disruptions, sanctions, and price caps, and no insurance and so forth?
Well, I mean, to be fair, we're still trying to understand it. I think the whole market is trying to understand it. It's clear that there is a fracturing of what goes into the clean market and what goes into the dark market. It's that will evidence itself over the coming months. Also where the product goes. Africa will take in the majority of the diesel and oil products that Russia export. But look, in terms of where we're seeing, say, MR Freight, your 37 KT vessels, they've increased that. It's increased 200% since September. So because what's happened is there's been a kind of a coming together of forces. So China clean product exports are record highs. They're higher than they have been for a long, long time, 1.6 million barrels a day in November. And then you've got less ships available in the market because the dark fleet just isn't there, or that older tonnage is moving into moving Russian or sanctioned material. So a 200% increase. Ship owners are laughing. Has that rolled out yet into crude? again, I think that we need to understand what happens with China. You know, we're seeing a massive increase in China buying in the last couple of weeks. Now that will be.
There also seems to be an issue, Matt. Again, we saw in the case of Turkey over the last week in the Bosphorus, how one interprets the insurance rule. The Turks seem to be interpreting it one way. The Americans apparently got on the phone call and told them, no, that's not necessary. Is there any sense of that sort of dominoing across the world, where ports and waterways and channels like the Suez Canal and others are faced with this sort of policeman role?
I mean, it's a good point. And one, you know, the unfortunate thing is that what's happening is a lot of seasonal changes, which are normal for this time of year. You know, there's a lot of fog in the Bosphorus. There's a lot of fog in the Houston Channel. Suez has its own issues. We're coming into you know, Chinese New Year buying as well, so that's an uptick in demand. That is usual for this time of year, but people are attributing that to what's happening vis-a-vis Russia. So I'm not a particular buyer of all these. You know, a lot of trade patterns have changed. So a lot of the Russian material is now lightering, and ship-to-ship operations are happening offshore Kalamata in Greece. Now that's a new region. But new regions form whenever there is a change in market dynamic. So it's largely I'm a little dismissive of the Turkish story. That something will need to happen, but whether they police that coming out of that, I'm not so sure. I think this is all seasonal at the moment.
Maliha, the macro picture, as discussed with Daniel there, we have the Fed decision this week. We had the report on the UK economy going into negative growth. We also had, I just can't be tempted, but published the bionic number of the US federal budget deficit widened to $248.5 billion in November, up from 191 in the same month last year. I mean, it's just staggering, really, the deficit and the debt that the US economy keeps carrying. But putting it all together, how do you see the fiscal picture as we come to the end of 2022 and the decisions that the Fed are making?
So the investors are desperate for a Fed pivot. But I think what's interesting is just because asset markets have fallen about 20 or 30% and tech stocks are down about 60%, the Fed's main agenda is either employment or inflation. And today, when we have the release, even if we get an inflation print of less than 7.3%, the market might rejoice that we're getting a lower print. We are past peak inflation, but the Fed's work is not done. And they've been very adamant that their work is not done. And we know the Fed plays a backward looking role, right? They need to see the 3-4% numbers before they can ease back off. Into Q1 next year, we might see non-farm payrolls pick up in terms of negative side. We'll see a lot more layoffs. So if the employment market gets a bit shaky, the Fed might be convinced to hold back a bit. But right now, they're going to monitor the data and keep tightening. So we're in a very restrictive economic tightening environment, which is not really bullish for risk assets. So we might cheer with the 25 basis points here and there market rally, but we're not really out of the woods yet because we are in a recession and the Fed has never been preemptive to hold back before seeing a crash effectively.
Are the equity markets getting ahead of themselves? Are they signaling? Obviously, they're looking forward, they're pricing forward. A lot of optimism come back into the financial markets in the last few weeks and months.
Absolutely. The market's actually unwound about 200 basis points of Fed tightening. So you can imagine the Fed would be quite annoyed that the work is being unwound by the equity market. The bond market actually is signaling quite a bit of worrisome. The market's pricing in recession. The equity market earnings, we're still forecasting 5% earnings growth for next year. And if you look back at any recession, your earnings year over year has to be flat to falling. So the equity market multiple is still at very, very high levels, which is why we think equities are very overvalued for the time being for the recession risks that we have. And a lot of people think recession might be quick, but we are in a place where rates can be higher for longer. So we can have a much longer protracted recession, and that's not being priced in by the markets at all.
And Daniel, we're seeing the oil markets possibly getting a lift from this hopium, as it was referred to on our podcast in the recent weeks, this hopium that the Fed pivot will happen, rates will ease, and it seems to be giving some upward oxygen into oil prices as we go into the end of the year.
Yeah, I mean, again, I don't think we're looking at a pivot anytime soon. We've had it for months now where markets have been pinning hopes on a pivot. Even back in the summer, we had that equity market rally on pivot hopes, which just seemed premature by anyone most people who are looking at markets or looking at macroeconomics. Certainly the conditions just aren't there for a pivot just yet. And even if they're not hiking 75 basis point, 50 basis point every time, they're not going to be cutting anytime soon. We don't think. We haven't really, like I say, it's manifesting housing data, but the labor market still, I think it's gone for 10.7, but still an extraordinary level of job openings, a slight uptick in initial jobless claims last week, which was grabbed at again by markets, but nothing significant still. So I think the expectations of a pivot anytime soon, and certainly this meeting, probably the next meeting, are premature.
Let's go into the survey question. Again, it's all about China as we end the year. It would appear a lot of contradictory messages coming out of China in terms of they're getting rid of their COVID app, but at the same token, hospitals seem to be, at least from reporting, starting to come under some stress with rise in infections. But will China reopening drive Brent crude oil prices back to $90 by the end of the year? There is some sense that the China reopening narrative, combined with the sort of fictional or not pivot, is giving some wind in the sails for oil prices. But China reopening, the big bionic pillar it has been for the oil markets for many years, are we seeing it return now and having an impact before the end of this calendar year, where everybody was sort of saying, no, second half of next year, but will it even come sooner with the sense of aggressive reopening in China? Yes or no? Your thoughts on that. Matt, welcome your thoughts on China, the China narrative, and get everybody's views on it. I mean, clearly, we've kind of baked in everything, the Fed tightening, now easing, monetary policy across the OECD world has kind of followed the same trajectory, some greater than others, but ultimately a big tightening year, and now it's sort of easing from the most aggressive posture. The Ukraine war is baked into pretty much most markets, unless there's some dramatic shift there. The one unknown ultimately is China. China has signaled its reopening intention. The speed in which, the impact in which will be the factor. Your thoughts on where do you think China goes into the new year and how quickly it can start to impact on the commodity markets?
I think straight away. I think people were waiting for this. There's a number of factors, Sean, that have come together. One was effect that a recession would have. I'd argue that it was too early to talk about pivot points where the ECB and the US interest rates are, whether that will be Q1 or Q2. I'd argue that recessionary headwinds have largely been priced in. I don't see the $40, $50 oil calls that people were making. I think that the world had a culmination of issues that should have meant that flat price was down at those levels, predominantly because China had long been the argumental factor regarding demand, and that China haven't been there. I was recently away. I've been away quite a bit this year, but recently on holiday with the family, and the resort was about 40% full compared to what it was when we were there early this time last year. But they said they are just waiting for China to reopen, and that surge in tourism, what that means, and what that means for globalization coming back. So there've been all these negative factors this year, but oil's still at $80 a barrel. I can't see more, apart from another, God forbid, another pandemic. It couldn't get much worse in terms of what people were fearful of. Massive recession, not enough oil, China being closed, globalization dead, air travel down. If it's culminated at the end of the year that flat price on Brent is at $80 a barrel, where does it go when China do reopen? I mean, the $100 argument is more than there, and I think your survey question was quite bearish in it. Does it get to 90 or does it get to 100? Does it get higher with China reopening? I think that is what the bulls have been waiting
targeting for. The end of the year time frame, which is literally 3 weeks away. Maliha, your thoughts on the same point there? I mean, the outlook for China from your analysis, we're seeing India really defying all of the logic this year in terms of fairly significant growth, immune to what would appear to have been fairly elevated commodity and energy prices, and typically India is quite sensitive to that, but yet they're still printing a 6-7% GDP growth this year. Your thoughts on the outlook, China, India, and demand going into the end of the year and its upward push on oil?
So the year end usually gets very tricky. China is reopening, but I think they're relaxing a lot of measures. Are they outright buying oil as they did before? I don't think the same thing. In Q1, it'll be a different story. But right now, this is just a relaxation of some of the measures. Also, going back a few months, China has actually stored a lot of inventories into this event. So they've actually been buying the crude Russian cheap oil to refine it and sell the products out. So we have a glut of product inventories right now that are building, and that's why oil prices are falling. So if you take a look at distillate demand and the winter heating oil demand, depending on how the winter shapes out, oil price can see some upside. But right now, oil is pretty fair value. It's fallen a lot, but I do not see China resurging back in because they're going through a domestic crisis. Maybe in first half is a different story, but right now we don't see, will oil go to 40? Probably not. Dan's right. But, you know, it's also very boring right now. And US and European demand is quite weak, and I think that's going to filter out. So we have a push and pull on both sides. So it's quite flat for us right now.
Daniel, last word to you. Let's get the survey results. We've just had the President Xi visiting the region, visiting Saudi, but having met with all of the Gulf leaders. What's the legacy of that visit, do you think, vis-a-vis this deepening of China-Gulf relations, and of course, when it comes to energy demand from China and being their biggest customer of most producers in the region?
Yeah, I think in terms of tangible takeaways, there wasn't anything huge that came out of it. A lot of pomp and circumstance, but I think perhaps that's the key thing anyway. It's the display of solidarity, that for Saudi Arabia's point of view, that they're not only beholden on the US, they have other partners, and for China making clear there is a friend to the region. But in terms of tangible takeaways, I don't think there's anything too much, pledges to cooperate on various things. But we saw that back when she visited in 2016 as well. And I don't think there's a special ramp up in those kind of cooperation levels. But I think just, the optics of it, I guess, is probably almost as important as anything actual, anything written down and signed that comes out of these kind of things.
Well, $50 billion of MOUs is I could sign that myself. Who's obligated ultimately. We'll have to see. Going to be clearly a big question this week will be whether Brent can break through on the upside to 80, or will it bounce its head on the ceiling and come back down towards 70 and get stuck in this range, or will there be some breakout moment that lifts it? I think a bearish commentary out of the Fed this week could be the oxygen to break back up through 80. We'll have to wait and see. But until then, thank you so much, Daniel. Really appreciate your comments and your insights today and throughout the year. Matt Stanley and Malia as well. Really great to have your partnership on the daily podcast. And we look forward to joining us in the new year. Happy holidays to you all. We'll be on air for the rest of the week, finishing on Thursday with the mighty Mike Muller and Christoph Ruhl, the final duo of this season. And it'll be a great way to end the year. But thank you, guys. Catch up every morning, 10:30 UAE time. All the best.
Happy holidays.